Hey, it's Rob. Welcome to Everyday Investor, the hottest investment show in the world. That's right, I said it. I don't care who knows it. We all want more time to spend with family and friends. We want time to engage in a purpose greater than ourselves, to have some sort of meaning in life. The challenge is we spend most of our time working to make money in order to live. Let me say that again. We spend our precious time working to make money in order to live. Imagine a life where money could make you money to live in order that we could work less and have more time for the things that matter most. Well, you can. Learn how from everyday people who are making this a reality. Don't go anywhere. We'll be right back. Coming up, Darren Voros teaches us how we can make money investing in purpose-built rentals.
You're checking zoning, you're talking with your architects, your team to say, is it possible for us to build 3-4 units on this lot? What are the implications of that? How long is that going to take? What's the cost?
Everyday Investor is brought to you by ProFunds Mortgages, fixed returns, real security. Clover Properties Rent to Own, invest with a purpose. Sam McDaddy Real Estate, full service brokerage for all your buying, selling, and investing needs.
Hey, it's Rob. Welcome back. On today's episode, we're going to be talking to my good friend Darren Voros, and we're going to learn how we can make money investing in purpose-built rentals. Remember, when anyone offers you any type of investment opportunity, you always want to ask the 4 questions to start. Number 1, what's the ROI, the return on investment? Number 2, when do I get that return along with the money that I put in? 3, what is the minimum cash amount needed? And number 4, what is the risk, the worst case scenario? Darren, it's so great to have you on the show.
Great to be here.
Yeah, thank you for being here. Yeah. I know that you've been busy. You've been kind of on tour with my friends Scott McGilvery and Michael Saraceni with Keyspire, and you teach real estate investing, and very excited about this topic. But before we get into that, more importantly, how have you been? What have you been doing?
I've been great. I just got back a couple weeks ago. I was traveling for the whole winter, pretty much. I packed my bags at the end of December and left for January, February, and March.
No.
And just got back.
Like working or for pleasure?
No, just relaxing. I was in Costa Rica and Mexico and Arizona and Miami. And it was a little hard to come back to the weather here, but it's been such a great trip, and I'm so glad to be home and get back at it.
You know, and that's really the purpose of the show. I mean, the purpose of the show is to help people, I don't want, my beloved audience to just make money for the sake of making money. I find that can be a very lonely life, and if we can actually learn from people that have been ahead of us, and you can see they're giving back, they're being benevolent, they're starting to realize that money's just a tool. Yeah. So to be able to go away for 3 months, it's because of your investments.
That's it fueled that for sure. That cash flow, that investing that I've been sort of doing over the last couple of years really allowed me to take some time and just relax, truly relax.
We are going to learn how to make money. You're going to teach us with purpose-built rentals. Mm-hmm. Explain what that is and explain the whole strategy.
So essentially, looking at purpose-built is something that is designed specifically as a rental property. So instead of taking a single-family dwelling, for instance, and converting it to a multiple-unit building, this is something that was built from the ground up as a rental building.
So we bought the land, we got out the hammer and nails, or we had somebody do it for us, and we're actually building something. Maybe it's just a house, maybe it's a duplex, maybe it's a quad.
Yeah.
And so we're building that for the purpose of, I guess I could sell it, and we'd call that a flip. I guess I could hold it, and we would rent it out.
Yeah,
That's
essentially.
what you mean.
Yeah, exactly. Okay. And in this case, the one that I just finished, we actually bought an existing property, tore that house down, and then did a purpose-built triplex with a coach house, so 4 units essentially.
Okay, so if you were to give me, the 1-2 minute kind of synopsis of how this strategy works, what would it be? I'm looking for a piece of land or something that is existing. I mean, there's some municipality that I've got to talk to as well, or?
Yeah, you want to find something that is, you're not overpaying for the property that's there, because essentially if you're going to tear it down, you really want to be paying land value. That's essentially it. Yeah. Take that structure down, and then the thing that we learned throughout this process, and when I've done this in the past, is the biggest struggle is generally permitting and things like that, dealing with the municipality, making sure that everything is legal. And then once you get into construction mode, it's pretty similar to any other type project that you're working on. It's just a matter of getting there. Sometimes takes a little bit longer than any other process.
So are we going to the city for the approvals or knowing that we can get the approvals ahead of time? I mean, I would think we would be doing that.
Yeah, you're checking zoning. You're talking with your architects, your team to say, is it possible for us to build 3-4 units on this lot? What are the implications of that? How long is that going to take? What's the cost? Before you even actually make an offer, I would do that, because you don't want to be getting into a situation where you realize you're going to be underwater very quickly and then you're wasting everyone's time. So we did all that due diligence on the front before we even made an offer.
In essence, it's building a home, but for the purpose of renting out.
For sure.
Yeah, and for cash flow. Or you could flip it. And
you could, yeah.
We're going to look at the last one you just did, and in that one, are you holding that property?
We're holding it, yeah, long-term investment.
And when it's all done, you're pulling money out. You've already pulled money out.
We already have. Yeah.
You've already pulled it out.
Just kind of finalized everything in the last couple of days.
And so is it true, Darren, that we can, if you do it right, you can be in for almost nothing?
We are essentially, I'm in for $0 at this point.
And okay, great.
Yeah.
I'm assuming you had
I have two other partners.
And they're in for a little bit?
They're in for a little bit, probably just their initial down payment on the original purchase price of the original property.
Wow.
Yeah.
Because you created something, it's worth more, and the bank says, okay, we'll give you only need a mortgage of 20%, is it?
Yeah.
You only need a mortgage of 20%, the rest you can take out.
And the caveat to that would be we would have been able to pay them back fully, except that they couldn't qualify because the property was worth more than we expected it to be worth in the end.
Are you serious?
Yeah.
So they would have been able to get all their money out, and then you just
But the bank would only go 65% loan to value. If they could have gone 75 or 80%, we actually would have all made money on the transaction and had.
Stop it.
Yeah.
Okay. Let me say that. Let me just understand. Let me mirror you for a second.
Yeah.
You're saying you bought something, you tore it down, you built it up, you got it tenanted, you went to the bank, they saw the new value, they saw income coming in, and conventionally it would be 20%. In this case, because of your investors' qualifications, they wanted to see 35%. Otherwise, if it was the 20% that was left in, everybody would have got paid out all the money they put in, plus taken a vacation, and this would be cash flowing. I see why you like this strategy. Yeah. So this strategy, though, this is not your real estate investing is pretty forgiving, generally speaking. But doing something like this is kind of the next step up, right? I mean, this is not your first endeavor in the investment world.
I say it's not for the faint of heart in some ways. You definitely want to, you have to know a little bit about this process. I wouldn't be going in as a first-time investor trying to tackle a project of this size and scope. Unless I was really confident in the team around me. But this is something that I've learned to do over years, and this has sort of like accumulated to this point now where I'm doing these on a regular basis.
I kind of hear you saying that the return on investment is almost infinite because you're pulling everything out.
Yeah. We essentially got to the point, and like I say, the property, we were hoping that the property was going to be worth X amount of dollars. We were looking at our after repair values or our after build values. And then, we were expecting the market to be, increasing slightly, but the value that came in the end, and we decided to upgrade some of the finishes as well, and so I think that helped the value in the end as well. But what it came out as, was far exceeded our expectations in terms of what we had originally gone in with in terms of our numbers.
Crazy.
But that's a better place to be in, I would imagine, than the other way around, saying, oh, well, I think it could be worth this, right? You never want to be at that point. I like to stay on the conservative side, especially when I'm dealing with partners, joint venture partners, say.
And so joint venture partners, quickly define what that means.
So essentially, joint venture partners would be, somebody that's coming into that transaction with me. In this case, my two partners on this were financial partners. They had no interest in really sourcing the property, finding the property, dealing with the renovation, dealing with tenants. That's all my responsibility as what we call the working partner. And they're just coming in, lending money to the transaction, and they get to reap the benefits of all the things.
So on this deal is Darren, Bill, and Bob. And Bill and Bob are writing checks to Darren because they, have seen his competence and they trust him. And so they're writing checks. They're the passive partners on this.
That's correct.
And you're the working partner. You're the one that's going to take everything. And you may not even have a hammer and nails, but you are overseeing that part of it.
Yeah, you don't have to be the general contractor. I mean, I was in this case. But, I'm lending my expertise. I could hire another contractor, a builder, as long as I'm the one managing that relationship, right? That's my responsibility as the working partner. But I don't necessarily have to swing the hammer.
So with all your different investment vehicles, you know, where does this kind of play on the chart?
I think this was a bit of a passion project for me. This specific one.
Yeah.
As well.
If you were the general contractor, I assume.
Yeah. And I've always wanted to build something from the ground up. So aside from that, though, I think when I really saw the project coming together, the long-term forecast on this property. I mean, talk about a property that doesn't need a lot of maintenance over the next 10 to 15 years.
Yes.
Rental rates, we're attracting the highest quality tenants. Our rents are at the top of the market. We actually set a record on our street for value in the neighborhood. So there was just a lot of really positive things about a project like this, and it was just such a fun project to be a part of.
Yeah, no, fantastic. So we're going to take a quick break, and we're going to look at the numbers on this specific property. We're talking to my good friend Darren. We're learning how to make money with purpose-built rentals. Don't go anywhere. Everyday Investor continues in a moment. Thanks for watching.
Everyday Investor is brought to you by ProFunds Mortgages, fixed returns, real security. Clover Properties Rent to Own. Invest with a purpose. Sam McDaddy Real Estate, full service brokerage for all your buying, selling, and investing needs.
Hey, it's Rav. Welcome back to Everyday Investor. Today we're talking to my good friend Darren Voros, and he's teaching us how to make money investing in purpose-built rentals. Darren, it's fantastic just being nurtured by you, learning this. I've not done this strategy. I always say I've done most strategies, but I've never done it. And my son's 18. He's actually getting his real estate license just for fun, so that we can do this together. And it's actually to make money, but I get to hang with my son.
For sure.
And have a fun project like this. So, in your case, as we were talking about Bill and Bob and the silent investors, if you will, did they come by? Did they want to, throw on a hard hat and walk around? I mean,
they were great. They helped out whenever I asked them to.
Yeah.
And they're two, younger guys just starting out in their careers and stuff. And so they were super excited about this project. And so they watched the whole thing beginning to end. But they also gave me the freedom to really manage the project. And I appreciate that, because there's nothing worse than partners that are kind of trying to micromanage you the whole time. So they were great on both sides of the equation.
Right. So let's look at this particular investment. So this is generally in the GTA.
Yep.
Greater Toronto area.
Yep.
Okay. So what was the purchase price on this?
$870,000.
$870,000.
Yeah.
Okay. And this was, you said there was something existing there, so you had to tear that down?
Yeah. We actually contemplated renovating the building, but once I started to take a few things apart, we realized very quickly, let's just take it down, start from scratch.
So you say building, so this was 4 units?
This was an illegal triplex.
Illegal?
Yes.
Triplex?
Illegal, yeah.
That Darren came into to make legal?
Yes.
Okay, so when we were finished, was it still a triplex?
So it was classed as a single-family dwelling. We converted it to a legal triplex with a secondary suite, a coach house, essentially.
And so what was the down payment and closing costs?
Down payment was $130,000.
$130,000.
The guys were able to qualify for 15% down because it's their principal residence.
Okay.
Closing costs were around 30, land transfer, closing costs, legal, that kind of thing.
Okay, and so that was interesting what you just said. So these investors actually now are the tenants of their own investment.
Yeah, that was part of the reason why they wanted this neighborhood, why they wanted to invest in this specific property, because they are living in one of the units. We call it the owner's suite. It's the top floor.
Yeah.
We kind of did a few upgrades in that one. So they're living there, yeah.
That is fantastic.
Yeah.
Okay, so here's the number. How much did this cost to build?
The build cost was $800,000.
$800,000.
Yes.
Okay. So you are all in $960,000.
Yep.
Now, if Darren wanted to put in his $960,000, you could have done this by yourself.
Yeah.
If you wanted to have 5 investors, you could have divided that. If you had one guy, if I had $960,000, then you'd say, "Hey, Rav, can you give me $900,000?" So
for sure.
But the point is that it's $960,000 to build this.
Yep.
Okay. And this took 1 year, 2 years, 3 years?
So it took us a year to get permits.
Yep.
And then it took us a year to construct the building.
Now that sounds like a long time, but is that generally what it takes to do it right, about a year to get the permits?
Well, because in any municipality, generally that you're outside of the zoning bylaws when you want to do purpose-built rentals. Because something simple like gross floor area, for instance.
Yes.
On a single-family dwelling, they only include the main and second floor.
Okay.
In a purpose-built triplex, they include the basement.
Got it.
So you're outside of the zoning bylaw on.
So you want to get that changed because you're changing the use of this
Yes.
building.
So you got to go to committee of adjustments.
Yes.
That takes 3 to 4 months to get an appointment, assuming everything goes well. Then you got to get building permits, all that kind of stuff. The nice thing about this was we kept the existing building. It was a rental.
Yeah.
We still had rental income coming in the whole year while we were dealing with the city. So it wasn't costing us anything.
I love that.
Yeah, and
so
that's
you
why
bought this, you had rent coming in during that year.
Yes.
And then
that covered all the costs for that year.
Yes.
And then we had the sort of move out process aligned with our construction start date, so there was no lag time. Yeah.
Fantastic. That's amazing. Okay, so we're done. Now we're done.
Yeah.
And so let's.
If only it was that easy.
Yeah, we're done. Took you 2 years, but I'm done.
Boom. Snap your fingers. There it is.
Thanks for being here. No. So we make money on this a few different ways.
Yes.
Okay. So the cash flow, the money that's coming in after all expenses. What was the difference?
We're essentially cash flowing about $3,000 a month.
$3,000 a month. So $36,000 a year was your cash flow.
Yep.
That's
it's significant.
That's significant.
Yeah.
That's significant.
Yeah.
I mean, you know, you do 2 of these, maybe 3 of these. Now somebody's made their 6 figures just on cash flow.
Yep.
Right? So $36,000 a year there. Now, what people, I find always miss, and I want to get your thoughts on this, is in my opinion, I don't want to buy something for $400,000 and then 15 years later it's worth $400,000. It's not what I'm really looking to do. But if I did that, Darren, if I bought it for $400 and I sold it for $400, but somebody else paid down that entire mortgage for me, I'm happy.
It's a solid investment.
Buy for 4, sell for 4, but I only put in, let's say 20%. I only put in 80. Somebody else was paying $320,000 of mortgage in 15, 20 years, depending on how I set up my, my mortgage with the bank. And so we call that, I call that mortgage pay down.
Yeah,
what do you call
principal
it?
recapture.
Principal recapture, okay.
Lots of different ways to phrase it,
Yeah, so somebody else paying that down every single month.
Yep.
So what was that, on an annualized
it works out to about $42,000 a year on this property.
$42,000 a year.
Yeah.
Somebody's paying down for me. $42,000 a year, somebody's paying that down.
Yeah.
Actually, 4 people.
Yeah.
4 different people are paying that down.
Yep.
And we always already put in there the amount that goes towards interest.
Yep.
Right?
Yep.
Because the bank needs to make money.
That's principal only.
Yeah, that's just principal only. It comes down like that. Okay. So $42,000.
Yep.
And then, this just naturally will go up over time. I like to say it's, real estate is like a yo-yo on an escalator, right? Up and down, upwards.
Yeah.
I know you like to, when you teach, you like to be very conservative.
Super conservative. I like to allow for, because you look at the historical data, in any real estate market, no matter what country it is. If you look at the Canadian real estate market, on average, the Canadian real estate market has done about 2 to 3% consistently over the last 100 years.
100 years.
So
that's what we should use.
That's what I use. I use 3%.
3%, just above inflation. And so we're 3%. So 3% on the new value.
Yes.
Okay, so 3% on the new value is now what?
$69,000 per year.
$69,000 per year, because the new value was?
$2.3 million.
Wow.
Yeah.
It's worth $2.3 million.
Well, that's a conservative appraisal done by the bank. On the open market, we truly believe this property is probably worth somewhere between 2.7 and 2.8 million.
No, but I like your style. I mean, we're not selling anything. But if we were, I would like to always under-promise, over-deliver. It's the best way to do. So on the 2.3, you use 3%. That's how you got your $69,000. Now, this is the big one.
Yeah.
You forced the appreciation by what you did.
Yes.
You increased the value by what you did.
Yeah.
So on top of what it was worth, you've increased this value by how much? Hundreds of thousands.
$630,000.
600. There's the number.
Yeah.
So you increased this value by $630,000.
Yeah.
Amazing. So we take our cash flow, we take our mortgage pay down or principal recapture, we take the natural appreciation on the new value of 2.1, and we take our $630,000. If we add all that up, that gives us, look at that, ding, 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 slot machine, $777,000.
Yeah.
$777,000.
Yep.
We divide that, whenever you're trying to figure out the return on investment, you take that, you divide it by what you're in for. So in this case, you were in for the $960,000, and that spits out 81%. We're in for 2 years, just over 40% annualized.
Yes.
But you've taught me, nobody does that, Rav. There's another step that we won't necessarily talk about on the show, But even if we didn't do this thing called refinance,
Yeah.
we made 40% per year
Yeah.
on our money.
Yeah.
But when we refinanced, tell me about that. What happened?
So essentially, when the project was done, we went to the bank. We said, we've increased the value of the property. We've got this brand new property. We would like to do, another mortgage, essentially, increase the mortgage value that's existing there. And the bank looked
because
at...
we can, because the tenants are paying for it. We're still never out of pocket.
Yeah.
Yeah.
And of course, the bank always looks at legal properties very differently than they do illegal.
Yes.
So the fact that we can show this is a legal unit, that really helps in terms of creating value and also the bank's comfort with lending us more money.
It's like a business.
Yes.
It's like a mini business.
For sure.
Okay.
So at that point, we went to the bank. They said yes, based on my partners, who are the ones holding mortgage and title.
Yeah.
They said we can allow you to go up to 65% of the value of the building,
Yeah.
which essentially they cut us a check for $750,000.
$750,000.
Yes.
And you're in for $960.
Yeah.
So we only have a couple $100,000.
Couple $100,000 left.
So
in the
this
project.
return is, almost infinite.
Yeah.
Right. We're not going to go to the numbers right now for the sake of time, but almost infinite.
Yeah.
So I love this. I love you. Have to have you back quickly before we close out. What would be the risk in this?
The risk, I think, the biggest risk is dealing with a reputable builder. Somebody that you trust. Now, I managed the project, and I was able to bring in all my tradespeople that I know are going to show up on time and for the prices that they've quoted me.
Yeah.
But somebody else doing this, unless you're a skilled tradesperson yourself, I would say just do your due diligence on your builder and your costs and all of those types of things. That is, to me, the most the risky part of this transaction.
Or have a Darren Voros on your side.
Yeah, exactly.
Yes. Listen, my friend, it's great having you. We'll have to have you back. Thanks so much for being here.
Great to be here. Thank you.
And thank you for tuning in. Without you, we wouldn't have a show. For more information on this show or any others, or to become an Everyday Investor Insider where you can get investment opportunities, tips, advice, go to everydayinvestor.com and sign up. Until next week, we'll see you same place, same time. Honey, I love you. I'll be home soon.